Hi, I'm Dan Fitzpatrick at stockmarketmentor.com, and I want to introduce you to MACD, Moving Average Convergence Divergence. This is an indicator that I call the Swiss Army knife of technical indicators, and this is why. It is both a trend following and a momentum indicator. It's an oscillator like RSI, stochastics, where it's built around a zero line. There's, from 0 to 100 or whatever. We'll look at that stuff in just a second. But so it's different than just a typical like accumulation distribution line, which just kind of trends up or down or relative strength, something like that. So I like the fact that it's an oscillator, and it also is something that's actually really easy to read, and we'll get into this in a second. But the point is, I call it the Swiss Army knife because it combines two approaches. It gives you the crossovers of moving averages, and then it also gives you the flexibility of an oscillator and the certainty of a zero line. Now, we'll get into the details in a second, but I always like to start with a chart so you can know what the heck we're looking at here. Don't let this confuse you. I'm actually hoping to get a little bit of clarification here. This is the MACD line down here. And if you look at 10-cent holdings, you can see this was in a pretty strong uptrend, and then ultimately what kind of looked like a triple top, and then you see this big downturn, right? So if you look at the MACD line, the dotted line here is the center line. And you'll notice that on the way up on the stock price, this MACD line was always above the center line, and it was only after the stock kind of topped and started to move lower that the MACD traded below the center line, and then it hardly ever got above that line. So if you just want to look at this is the part of the uptrend. This is the part of the downtrend in the chart. So it's really, really obvious that way. But here's how it's actually constructed. Okay, we start with two exponential moving averages, and these are short ones, a 12 period and a 26 period. That's different than like the 200 and the 50-day moving average. And then what we do is, and the software does it for you. All you got to do is select MACD and boom, you're in. The MACD line, moving average convergence divergence, is the difference between the 12 and the 26 period. We'll just say it's day. 12 and the 26 day moving average. That's actually the faster line. Again, it's the difference. It's a number. And then the signal line is the 9 period exponential moving average of the MACD line. So this is a slower line. It's a moving average of a moving average of the distances between two moving average. So this is a really, really slow line. But keep in mind, the underlying moving averages, the 12 and the 26 moving average, those are invisible. You're not going to see those. All you're going to see is the moving average of the distance between them and then the signal line. So we'll look at this, for example. Whole Foods, you can see how the stock had been oscillating here, and on the way up, the MACD line is above the midline. It's in an uptrend. Now, on the way down, technically, because this is still above the midline, technically, the price is still in an uptrend. It's only when the MACD line starts to fall below the midline is it technically in a downtrend. So let's just look at some real basic classifications so you can get on your way with this indicator. For crossovers, if the MACD line crosses above the signal line, it's a buy signal. If it crosses below the signal line, from above to below, it's a sell signal. But the issue is you're going to get a lot of false signals here. You can look at the different crossovers here, look at the different crossovers here. So you get a lot of false sell signals if that's all you are looking at. But if you stick to extreme distances for the crossovers, like stochastics, that's going to give you a better result. So MACD is good for decision making, not for action taking. It really gives you an ability to kind of classify things. And this is what I'm talking about. I'll leave you with this simple chart here. If the MACD is above the 0 line and it's moving up, then it's in an uptrend and momentum is increasing. If it's moving down but it's still above the 0 line, it is still in an uptrend, but momentum is decreasing. And just the opposite for if it's below the midline. If the MACD is moving up, but it is still below the 0 line, well, it is still technically in a downtrend, but the downward momentum is decreasing. And if the MACD is moving down and it's below the 0 line, downward momentum is increasing. In other words, definitely a stock you want to stay away from or be short. So with that simple classification, here's how you can use it. Only be long stocks that are in the green here, okay, that are above the 0 line and momentum is increasing. Only be short stocks if the MACD line is below the 0 line and it's moving downward. If you can stick with these simple rules and use these literally as parameters, like I will not be long stocks unless these parameters are met, or I won't be short stocks unless these parameters are met, then even though this is a lagging indicator, this lagging indicator will absolutely keep you out of trouble and keep you on the right side of the trend. Okay, I'm Dan Fitzpatrick. I'll see you next time. And by the way, there is a more detailed version of this tutorial for members over at stockmarketmentor.com. So if you liked this and you want to learn more about it, definitely check that out for a free trial.